This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 5 videos on climaxes. In this video, I'll be talking about what I mean by climax. Every trend bar is a breakout and a climax. If a breakout occurs early in a trend, I refer to it as a breakout. If it occurs after a trend has extended for 20 or more bars, then I start referring to it as a possible climax. All major reversal patterns involve trading ranges most of the time, and that includes climaxes as well. For example, a climax is often a breakout from a final flag. Also, whenever there is a climactic reversal, there eventually is a pullback, and that pullback is a small trading range. Every trend bar and every series of trend bars is a breakout and a climax. I use the term climax to refer to a breakout that occurs late in a trend and is followed by an end of the trend, either by the market going sideways or going in the opposite direction. A climactic move is often an acceleration of the move. For example, we're going down with lower lows here and lower highs, and then we have an acceleration down. We have a breakout, and it turned out that was the end of the trend. Likewise, the market's going up here, and we're accelerating up again here and again here. This is a buy climax. This is a buy climax. This is a buy climax. Buy climax. Buy climax. The series of 4 bars is a buy climax. Another buy climax. Another buy climax. A 10-bar bull microchannel. That's a breakout and therefore a buy climax as well. I don't use the word climax to refer to a breakout until the bars after the breakout show that the trend has ended. Either reversed or halted became a trading range. Most climaxes lead to a 3 to 5 or 10 bar trading range, and then the market decides whether it will reverse or resume. Here we have a buy climax and a pause, and the trend resumed. Here we have a sell climax and a pause, and the trend reversed. In general, whenever there's a climax, 50% chance of a trend reversal, 50% chance of trend resumption. We got a trend reversal here, and we had a buy climax and an attempt at a reversal, but it led to trend resumption here. 50% of the time when you have a climax, here a sell climax, you get a reversal. 50% of the time when you have a climax, you get trend resumption. Breakouts usually fail, and therefore there's usually at least a little climax. Most climaxes are only a single bar and lead to a minor reversal. For example, a pullback in a trend or a leg in a trading range. Here we have a sell climax and it led to a reversal. The reversal was a buy climax, and that led to a reversal down. This reversal down is a sell climax and it led to a reversal up. Every trend bar is a climax. Here's a buy climax, a pause, and we continued up. Here's a buy climax and a bear bar, a pause, and it led to a reversal down. Most of the reversals are minor. For example, here we have a buy climax and it led to a reversal down that became a higher low, a bull flag and a bull trend. Again, a sell climax and it led to a bull flag and resumption up. Here we have possibly an early bear trend, possibly a bull flag that could lead to a resumption up. And we have a buy climax and it led to just a pause, a bear flag, and trend resumption down. Even when there is a successful breakout, it still usually results in only a minor leg in a trend or a trading range. Here we have a successful breakout, strong breakout, follow through bar, and it only led to what became a trading range. Big down, big up, big confusion, trading range, and then breakout mode, either for a reversal or resumption down. A buy climax, the bulls are becoming aggressive. Instead of bears selling at the high, the bears are getting overwhelmed by bulls willing to buy at the high. That's a sign of strong bulls. That trend bar is a sign of the bears giving up. Too many bears buying back shorts, too many bulls buying aggressively. And the same right here as well. There are always bears selling at the prior high, and this bull trend bar shows that those bears were trapped, and many of them quickly bought back their shorts. Bulls saw that as well, and they bought as well. However, whenever you get a big bar late in a trend like that, chances are it's going to lead to a climactic reversal and at least a trading range and maybe an opposite trend. Sell climax. The bears were very aggressive briefly, but they were overwhelmed by the bulls right here. And this big bull bar after that bear bar is a combination of the bears giving up and the bulls buying. A climax can be as brief as a single bar. Here's a single bar sell climax. Here's a 3 bear bar sell climax. Climaxes can also last for many bars. For example, here's approximately a 7 or 8 bar bull microchannel. It would be a breakout on a higher time frame chart. On this time frame, it lasted about 8 bars. And again here, another bull microchannel, buy climax, lasting many bars. Whenever there's a successful breakout, you often get a swing and a measuring gap, the start of a new trend. Most breakouts typically fail and represent a climactic end of a trend or a leg in a trend. And therefore, most climaxes end up being exhaustion gaps. We have a gap between the close of this bar and these lows, and also the close of this bar and these lows. We have another bar in the sell climax, so now the gap is between this close and all of those lows. We get a bull reversal here. The bears hope it's simply a pullback, testing the breakout. They want the bear trend to resume. At this point, at the close of this bar, the gap is from the high of this bar and that low, the first bar of the climax, this low, and any of these lows. All of those are gaps, and they all close with this big reversal up. And at that point, once all of those gaps close, you look at this bear breakout, a sell climax, and you call it an exhaustive sell climax. And all of those gaps are exhaustion gaps. We're starting to trend down. We have a 4-bar bear breakout. At this point, we don't know if it's going to be a measuring gap leading to a measured move down, or if it'll fail the way this one failed, and the bull trend will resume up from a higher low. The bulls tried to resume up here, just like they did over here, and the bears turned it down again, and there's a gap, these highs and that low. This is a breakout test of the breakout point, and once it starts to turn down, especially with a couple of bear bars, the odds of it falling for a measured move go up. Initially, you're going to look at the most recent lower high for the measured move projection, this lower high to the gap. If it falls below this line, traders will then look for a measured move based upon the top of the bear trend to the middle of the gap. The measured move down would be here. We have a trading range and a bear breakout. A very strong bear breakout, but still a breakout, and most breakouts fail. And the gaps close, and then the breakout becomes an exhaustion gap. I would call this series of 3 bars an exhaustion gap. Once this bar went above that low, this low, this low, that low, all the gaps closed, and therefore this is an exhaustion gap. I know there's no actual gap there, but it functions exactly like a gap. And this reversal up closing the space or the potential gap means that it's an exhaustive end of the trend. That means that the market either goes sideways, or it could reverse, or after 5 or 10 bars, it could resume down again. It simply means this breakout phase has ended. We have 3 consecutive bear bars and then a bull bar. At this point, the gap is from this close to any of these lows, or at the close of this bar, it's from the high of this bar to any of those lows as well. When you have a sell climax and you start to get a reversal, the target is the top of the sell climax. The market usually tries to go at least a tiny bit above that high. Sometimes it reverses down. Usually it goes sideways at least a little bit. If it reverses down, the bears see this as a double top, this high and that high. They see this as the neckline. They look for the bear trend to resume, break below the neckline, and fall for a measured move down. The bulls look for the reversal down to fail, and they want a bull breakout above the double top, and then a measured move up from the neckline to the double top. Whenever you have a climax that reverses, the first target is always the start of the climax. In a sell climax, it would be the high here. On a buy climax here, if it starts to reverse, the first target is the bottom of the buy climax here, and then possibly all the way down there. Sometimes when you get that reversal, you get an opposite trend. Most of the time, the market goes sideways for 5 or 10 bars and then enters breakout mode for either a reversal or a resumption. Very strong bear breakout late in a bear trend. Very strong bull breakout late in a bull trend. This is the traditional definition of a climax, that you have a strong surge late in a trend, and then an abrupt, unexpected reversal. And unexpected means low probability reversal. When you see the bulls try to break to the upside here and fail, and the market reverses down strongly here, and then has a second consecutive bear bar, this bar closing below the lows of this 20-bar trading range, traders think at that instant the odds are pretty good that we're going lower. The bulls tried to break out and failed, and now we have a bear breakout. It's unexpected that you would get another reversal. And therefore, this is an unexpected event, a sell climax that led to a reversal. That's the traditional definition of a climax. Here, it went down, it went up. That would be a B bottom. When you get an abrupt reversal at the top, a buy climax, traders expecting a measuring gap, the close of this bar and these highs, maybe a measured move up. We're starting to pull back. The bulls were hoping that this would pull back for only a bar or two and then resume up and form a gap, maybe from the low of this bar to the high of these breakout points, and then a measured move up. First leg up, and then gap, and then measured move up. Once you get 3 or 4 consecutive bear bars closing on their lows like this, chances are the market's going lower, and the market's going to close the gaps. At this point, the gap is this low and this high, and this low and these highs as well. They're all breakout points, and typically, once it starts to reverse, it's going to fall below all of those breakout points, and usually it tests at least a little bit below the bottom of the buy climax. Climax, climactic reversal, two terms for the same thing. You get a climax and then a pause. And sometimes you get a reversal, sometimes you simply get a pause. Here we have a buy climax and a pause. Instead of a reversal, we got trend resumption up. We have a second buy climax here and a pause. And this time we got a reversal. Down at the low here, we were selling off strongly and we reversed up. Instead of a pullback, there's no chance to exit without a loss if you're a bear who sold anywhere down here. And the opposite is true here. If you bought this close, confident that you were going to get a measured move up, you never got a chance to get out break even. You were disappointed by this bear bar. Maybe you tried to place a limit order to get out of your longs to break even. It never came back, and you ended up having to chase it down. If you want, you can call that an inverted V top or a V top and this a V bottom. I always call it something else because it is always something else. Again, a climax can be a single trend bar like this, or it could be 2 or more trend bars like this. It's an extreme acceleration in the move up or down. Here we tried to break strongly to the downside, yet we reverse up. Here we tried to break strongly to the upside, and we reverse down. This is a buy climax. It's a bull breakout, a bull reversal, but it's a strong buy climax, and it's unexpected. The odds are we'll get at least a second leg up. Here we have another breakout. It's probably strong enough to get more up, but once you see the bad follow through, the bear bar after the bull bar, the bear bar closing on its low, a lot of bulls will exit below that bar. A lot of bears will sell. Higher probability, wait until we get 2 or 3 consecutive bear bars closing on their lows, and then sell closes. Any unsustainable move late in a trend is a climax. Once the trend lasts 20 or more bars, if anything is unsustainable, for example, a very tight channel, a micro channel, a very tight channel, it's probably climactic. However, even though this is climactic, it can last a long, long time. The bears tried to reverse it here with an acceleration upward, and instead of a reversal down, we fell below the bottom of the buy climax bar here, went sideways, and then we rallied again in a very tight bull channel. All of this is climactic. On a higher time frame chart, it's a series of bull trend bars with no pullback. If the trend continues, this is all climactic, it's a buy climax. The trend's continuing, I call it a breakout. If the trend pauses or reverses, then I say it's a climactic breakout or a climactic move, a failed breakout. It's a buy climax. This is all a buy climax, and it's still a buy climax. And then once it starts to do this, traders start to apply the term climactic end to the trend or a buy climax. But the entire thing is a buy climax. And this entire rally is a buy climax that just went on for a long, long time. Every trend bar is a breakout. Every trend bar is a climax. I talked about that earlier. All markets are constantly trying to break out. Most breakout attempts are brief and fail. For example, the bears tried to get a breakout here, brief and failed. The bears tried to get a breakout here. They tried to get a bear breakout here below this bull channel, and it failed. When you get these little bear breakouts on a smaller time frame chart, they can be dramatic, but on this time frame, they're trivial. On a smaller time frame chart, every one of these breakouts up and down can look very impressive, but on this time frame, they're minor. Yet we just kept getting climactic moves up and up and up and up, and then we started getting them both up and down here. In the market sideways, balanced after 20 or more bars, the probability of a successful trend resumption up falls to the same as the probability of a trend reversal down. Here, we did get trend resumption up. Look at this segment on the 5-minute chart. This is probably 30 or 40 bars in a very tight bull channel. A tight bull channel is always a breakout on a higher time frame chart, and therefore it's always a clear climax on a higher time frame chart. For example, this green box is this. This is the 60-minute chart. It's 3 big bull trend bars. Here is the 5-minute chart, and it's 36 consecutive bull bars in a very tight channel. Whenever I see that tight channel, I know on the 60-minute chart it's going to be a strong breakout. Occurring late in the trend, it's a climax. Usually, eventually, it's going to lead to some pause, some halt to the buying, not necessarily a reversal. I usually reserve the term climax for a breakout that occurs late in the trend, after 10 or 20 bars in the trend. But any trend bar or series of trend bars is a breakout and a climax. This is a buy climax. This is a buy climax. These 3 bars, buy climax. These 2 bars, these 3 bars, buy climax. And then sell climax, a 3-bar sell climax, a 2-bar sell climax, or you can call it a 4-bar sell climax. Here, a 5-bar buy climax. Usually, when I see a breakout early in a trend, this is a possible bull trend, I call it a breakout and not a climax. And I usually refer to a big breakout late in a trend as a climax. Here, this would be a sell climax, and it's the biggest bear bar, 20 or more bars into the bear trend. Chances are it's going to be an exhaustion gap, and we're going to trade up above its high after a brief follow-through sell-off. A bull breakout late in a bull trend, a fairly strong bull breakout, I would call it a buy climax, and I would be thinking that it might be an exhaustion gap, a gap between this close and this high. And then once we start to reverse down, the gap now is this low and this high and that high. And at this point, I'm seeing a strong bull breakout late in a bull trend, and it's starting to reverse. At this point, I believe it's probably going to be an exhaustion gap, and that we'll get a pullback below all of the breakout points, including this low, and we'll probably test a little bit below the bottom of the buy climax, and then decide whether to go sideways and resume up or continue down for at least a measured move down based upon the height of the buy climax. When the market comes down to the bottom of that buy climax, it often forms a double bottom with that low, rallies, often above this high. That would be the neckline of the double bottom. Bottom here, break above that point, neckline, measured move up. On the other hand, if it breaks below the double bottom, which it did, then traders look for a measured move down. From the neckline to the double bottom, measured move down. We fell more than that. I know it never really bottomed here, and I know this is really not a bottom. It's a pause and a rally, but it's a potential double bottom. Whenever the market rallies in a buy climax, its low is often tested over here, and very often it resumes up, forms a double bottom. Sometimes it only pauses briefly or not at all and continues down. Since there was the possibility of a double bottom here, I call it a double bottom, even though there was no significant attempt at a double bottom in this case. Once we break below this low, I look at it as a failed double bottom. I'm looking for a measured move down. A bear breakout, and therefore it's a sell climax, and it's the strongest bear bar, the biggest bear bar, occurring late in the bear trend, probably an exhaustion gap. The gap initially is this close and these lows, any of these lows, and then we have another bar. It's this close and that low, this close and any of these lows, all breakout points. Once we start to reverse here, and then we start to resume back down, the gap is this high and that low. It's possible it's a measuring gap and will fall for a measured move down. More likely, the biggest bear bar occurring 20 or more bars into a bear trend, it's an exhaustion gap, and the gap will close. The gap between this low and that high, and an exhaustion gap, an exhaustive sell climax late in a bear trend, the market usually goes at least a little bit above the top of the sell climax, and then decides, does it go sideways and then resume down, or does it reverse up for a measured move? When you get a breakout at the start of a trend or the potential start of a trend, I do not use the term climax. Instead, I call it a breakout. I would call these three bear bars a bear breakout, and this a climax. A breakout late in a trend, I tend to call it a climax. It could be a measuring gap. A breakout late in a bear trend, again, it could be a measuring gap, but I suspect the strongest breakout in a bear trend that's lasted 20 or more bars, it's more likely going to be an exhaustive sell climax. Here, a breakout, the start of a potential bull trend. Here, a breakout, the start of a potential bear trend. But it's also a climax, and it's also a series of trend bars. Just like this led to a reversal, it's a breakout, a failed breakout, and it's a series of trend bars. Every trend bar, every series of trend bars is a breakout, and it's also a climax. When it occurs late in a trend, it's more likely going to be a climactic end of the trend. When it occurs early in a potential trend, it's more likely going to be the start of a trend. Bull breakout, and then it reversed down, and once you get 2 or 3 or 4 bear bars, it's a bear breakout. A bear breakout below this very tight channel. A bull breakout, we have 5 consecutive bull bars closing on their highs. And initially it's a break above this very tight bear channel, and then ultimately it's a break above this channel. I'm always looking at support and resistance. Here we have a bull trend, and we have a buy climax. The biggest bull bar in the entire bull trend, a bull trend that lasted 60 or 70 bars, this is probably going to be an exhaustion gap. The gap between this close and this high. Once you get that bear bar, traders will start to sell. Bulls will sell out of their longs below this bar. Bears will sell into shorts, expecting at least a test of the bottom of the bar. They certainly expect the gap to close. This is probably going to be an exhaustion gap, the biggest bull body occurring 20 or more bars into a bull trend. It's higher probability for the bears if there are other reasons to sell. For example, resistance. You can draw a trend channel across the top of this section of bars, and we have a bull breakout, 75% chance the breakout will fail and reverse down to the bottom of the channel, 25% chance it'll continue up into an even stronger bull trend. We're getting the reversal here. That means the top of the channel is resistance. A prior high is resistance as well. We broke above it, and then we reversed back below it. So we're failing at the prior high. Here's another prior high. We failed with the breakout above that high as well. We have a double bottom bull flag. We have a bull trend, a pullback, a new high, another attempt to reverse down, maybe a wedge, 1, 2, 3. And instead of breaking below this lower high, we're forming a double bottom, and we're continuing up. We're breaking above the neckline of the double bottom. Traders have to be thinking about a potential measured move up. Once it gets there, the bulls take profits, and bears start to short. That means that measured move target is resistance. I have a bigger list of what constitutes support and resistance in the video on support and resistance. The more reasons that there are resistance, the more likely this breakout will be an exhaustion gap. Market's in a bull trend, and then a trading range. This is the top of the range, this is the bottom of the range. And we're getting a bull breakout. This is a bear channel, bull flag, bull breakout. But whenever you're getting a rally in a trading range, chances are it's going to fail, and the rally, no matter how strong, is simply a buy vacuum test of resistance at the top of the range. Here we have a very strong reversal down, but it's still in the range, and chances are it's going to be a sell vacuum test of the bottom of the range. Here, the bears got follow through, and they got a measured move down. A series of strong bull bars, and then another pair of bull bars, another big bull bar, another pair of bull bars, and then a series of bull bars here. A series of consecutive buy climaxes usually leads to exhaustion and a trading range, and sometimes an opposite trend. No more buyers. They're all exhausted, and they'll wait 5 or 10 or more bars before they'll think about buying again. They wait to see if the bears will be able to reverse the market, or if the bears will be unable to get a strong reversal. You can see the bears got a breakout below a channel, but they could not get follow through, and the bulls see that, and then the bulls started buying again, and the bears gave up. We have a very strong rally up here, but it's in a trading range, and more likely it's simply a buy vacuum test of the top of the range, and you'll get a reversal down into the range. Here, we not only got a reversal down into the range, we got a trend reversal, a higher high major trend reversal, bull trend, bear break below the bull trend line, a trading range, and then a higher high. The market is getting vacuumed up to the top of the range, resistance. The bulls are trying to get the breakout above the range. More likely, the bulls will take profits because in a trading range, they're expecting that the breakouts will fail, and therefore they're going to be quick to take profits near the top of the range. The bears also expect the breakouts attempts to fail, and they'll sell at prior highs, at this high, at this high, at this high, and this high, betting that the breakout will fail and it will come back below all of these highs. Whenever you get a strong sell-off like this that reverses up, it's usually a sell vacuum test of support, even if you don't see the support. Very strong sell-off, another climax, another sell climax, another sell climax, and then a reversal. This is probably a sell vacuum test of support. For example, it's testing this prior low. Some traders would call only these 3 bars as the sell vacuum test of the prior low. I would call the entire sell-off as simply a sell vacuum test of support and the bottom of a developing trading range. A pair of bear bars, a climax, bear bar, climax, bear bars, climax, climax, climax. When you get a sell-off that comes in the form of 3 or 4 or more sell climaxes, usually the market will end up exhausted and it will go sideways for 10 bars or so, sometimes 30 or 40 bars as it did here. And then the market either reverses up or resumes down. When you have a lot of consecutive sell climaxes without much of a pullback, usually the market gets exhausted. No more sellers at this price. They'll wait to see a reversal. If the bulls are not particularly strong on their reversal, the bears will sell again. Here we have a single sell climax, and it's a second leg down. We have the first leg down. The bulls thought it was a bull flag after this breakout. They were expecting a bull breakout. Instead, we're getting a bear breakout below this bull flag, and it's a single sell climax. Usually when you get a single sell climax and the market finds support and tries to reverse up, it's simply a sell vacuum test of support. It's a sell vacuum test of this area here where the bulls bought earlier. Testing the prior low, a possible double bottom, and possible trading range. Big up, big down, big confusion usually means trading range. Here's the final leg up in the bull trend. It's a climax. We have 5 consecutive bull bars, pretty strong looking bull bars. The market sold off to test the bottom of the buy climax. Instead of bouncing and maybe forming a double bottom, breaking above this neckline for a measured move up, it broke strongly below the bottom. Remember I said earlier, whenever you have a buy climax, the market often comes down just a little bit below, and it can reverse up and view this as a double bottom. We do not have a bottom here, but it could have been, and we break above the neckline for a measured move up, or we break below the bottom of the buy climax and fall for a measured move down, which we did here. The more reasons for support, the more likely this is simply a sell vacuum test of support, and the market will reverse up. Weekly chart, daily chart. A buy climax late in a bull trend, consecutive buy climaxes, here, 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 here. Once you get 3 or 4 consecutive buy climaxes, chances are you're going to get a pullback and a pause. Probably this is going to be an exhaustion gap, a gap between this close and these highs. And then we have a pause bar. The gap at this point is from this low or that low and these highs. Chances are the gap will close, will fall below the breakout point, and will fall below the bottom of the buy climax. The bulls are hoping for a double bottom, slightly lower low double bottom. They want to break above the neckline for a measured move up. The bears want a break below the double bottom and a measured move down. Sideways, late in a bull trend after a series of buy climaxes. If you do get a bull breakout, this is probably going to be the final bull flag before the market evolves into a trading range. I can draw a bull trend line below and create a parallel, and you can see the market's trying to break above the top of the bull channel. 75% chance the breakout will fail and will get down to the bottom of the channel. Possibly a parabolic wedge, 1, 2, 3. So another reason why this general area is resistance. On the weekly chart, 1, 2, 3. This area on the daily chart is simply this area on the weekly chart. And there's a wedge here, which is this line, parabolic wedge. But there's also this line, which is this line here. So not only is there a parabolic wedge on the daily chart, I do not have it drawn in, but it would be here, up here. There's a much larger wedge on the weekly chart. Again, another reason why this is resistance. The bears tried to get a top here. Instead, we get a bull breakout. A double top this high, that high, bull breakout, measured move up. Here's that measured move target. More resistance. The more reasons why this price level is resistance, the more likely this buy climax is simply a buy vacuum test of that resistance and an exhaustive end of the move, an exhaustive buy climax. Sell climaxes end at support, and it's always good to look for support. We have sell climax, a 1-bar sell climax, a 2-bar sell climax, 2-bar sell climax, and a 2-bar sell climax. This is stronger than all of these bars. It's comparable to the strength here, but it's a strong sell climax, a strong breakout late in a bear trend. You have to be thinking that it's a probable exhaustion gap, a gap initially this close and that low. Once you get the reversal, the bears are trying to resume down here. The gap is this high and that low, and you can see the gap closed. Chances are we'll get at least to the top of the sell climax, and we got much more. In fact, we got more than a measured move up from the neckline of the potential double top this high, and then here or here, and we broke above it and went for a measured move up. Consecutive sell climaxes, traders have to be ready for a possible reversal, and you look for other reasons as well. Horizontal trading late in a bear trend. If you get a bear breakout, a probable final bear flag, and then we have a break below a trading range, so traders will look for a reversal around a measured move down. Double top here, fell below that neckline more than a measured move down, which would have been here. Traders then look at a measured move based upon the entire trading range. Neckline, and here's the measured move target. Sell climax, leg 1, pullback, leg 2. Another reason why there could be some profit taking there. 3 pushes down, so a wedge, and we got a reversal up. Another reason why this is probably going to be an exhaustive end of the bear trend, and that the market would then either reverse into a bull trend or evolve into a trading range. I talked about what I mean by a climax in this video. A climax is simply a breakout, a trend bar, or a series of trend bars occurring late in a trend. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 5 videos on climaxes. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 5 videos on climaxes. In this video, I'm going to be talking about V-tops and bottoms. I rarely ever use the term V-top or V-bottom because V-tops and bottoms usually are something else. A very strong bull breakout and then a very strong reversal down. It's a V-top. Perfect V-tops and V-bottoms are extremely rare, usually only present on smaller time frame charts like 1-minute charts or 5-minute charts, usually news related. And even when they occur, there's usually a more complex pattern on a smaller time frame chart like a wedge or a parabolic wedge. I always find something else. Whenever I see something that someone might call a V-top. Here, they would call it a V-top. Some traders use the phrase inverted V because it's an upside down V. I always know there's something else, and I always look for something else. For example, if this was a bull trend and then a trading range, this would be a higher high major trend reversal. There's also a parabolic wedge, 1, 2, 3, and then there's a smaller wedge on a smaller time frame chart. We went up, we went down, we went up, we went down, we went up. The more reasons to enter on the reversal on the sell, the higher the probability that you'll make money. Wedge, 1, 2, 3, and it's subdivided into a smaller wedge, 1, down, 2, down, 3, a nested wedge. A bear inside bar after a buy climax. A buy climax, you expect at least a small second leg up. This pause could be a 1-bar final flag leading to a reversal down, which it was. Parabolic wedge, 1, 2, 3. We got a climactic reversal, but eventually there's always going to be a lower high. If that lower high retraces a third or more of the initial leg down, then that lower high is a lower high major trend reversal. Again, if you have a reversal down after a buy climax, and then a pullback to a lower high, and that lower high retraces at least a third of the sell-off, I would call this a lower high major trend reversal. We have a bull trend, a strong bear breakout, a two-legged rally to a lower high. Traders will sell below the low of that bar, taking a chance that we'll get a swing down. We have a strong bull breakout, and initially there's a gap between the close of this bar and the high of any of these bars. We went sideways. We have a buy climax, but we did not reverse all the way to the bottom of the buy climax, and we did not close the gap, at least not for 30 or 40 bars. The minimum goal after a buy climax, a pause in the trend. Here we got a trading range that lasted about 30 or 40 bars, maybe 50 bars. And then the market decides whether to resume up or reverse down. Here it did both. It resumed up, and that failed, a buy climax, a climactic end of the trend, and we got a bear trend in the opposite direction. We have a buy climax, pause, trading range. A buy climax, trading range. Buy climax, now a reversal. Sell climax, tried to reverse, it became a bear flag. Sell climax, tried to reverse, became a bear flag. Most climactic reversals are followed by trading ranges and not opposite trends. Bull trend, trading range, trend resumption up. A big breakout, big bull trend bar, so therefore a breakout, and a climax. We have a gap, the close of this bar and the high of that bar, and it closed on the very next bar. So this became an exhaustion gap. This closed to that high. And not only did it end the bull trend, it led to a reversal. We have a bear breakout. You can call this a bear breakout as well. It's a bear trend bar, and therefore it's a breakout, and it's a sell climax. This reversal led to a trend down. We have a bull trend, a weak bull trend, and then we have an exceptionally strong bull bar. It's a surprise bar. Nobody was expecting that, and therefore it's a low probability event. A lot of bulls will see this as an exceptional gift, a surprise gift, and they'll use it to take profits. If they take profits, they're not looking to buy again on the next bar. They'll usually wait 5 or 10 bars to see if the bears will get a reversal. If the bears fail to get a reversal, then the bulls are willing to buy again and try to get trend resumption up. The bears know that the bulls have a gift here, and strong bears will sell, at least for a scalp, betting that the bulls will take profits. Why would the bulls take profits? They don't want to take a chance that this gift quickly disappears and they lose all of their profits. For example, right here, a similar bar, very big bull trend bar, very big bull trend bar. The bulls took profits Here, the bulls who did not take profits ended up giving back all of their profits. That's why smart bulls always take at least partial profits whenever they have a surprisingly big bull trend bar. There's no one left to buy at this price. The market has to go sideways and then decides if the market can reverse. If it cannot, the bulls will buy again. What about the strong bears? The strong bears will sell here and they'll sell more here. They're never going to buy back their shorts. Part of what is taking place here is weak bears are buying back shorts. They're looking at a weak rally. They're betting that eventually it'll turn into a trading range, and they're selling. They're selling below bars. They're selling above bars. And then they see this. The market's racing up quickly. They cannot take the pain. They buy back their shorts. The weak bears are buying, causing the market to go up. The weak bears are buying, causing the market to go up. The weak bulls are buying as well. They're looking at the trend saying, it's not all that strong. I need signs of strength. And then the market starts to accelerate up, and the weak bulls start to buy, and they find themselves buying at the top of the bull trend. Exactly where the strong bulls are taking profits, and exactly where the strong bears are selling. Here, the strong bears were unable to get a bear trend, but they were able to get a scalp trade, and the strong bulls bought again. Strong bulls took profits, strong bears sold, and this time the bears were able to get a reversal down. The weak bulls buying late in the trend, they're just not strong enough. They don't have enough dollars to keep the bull trend going. And the strong bulls take profits, and they're only looking to buy again lower, and they'll only buy again if the bears are unable to create a bear trend. So the strong bulls will be buying here. They will not be buying after they see the strong reversal down. If you're a strong bull taking profits here or here, you're not looking to buy again on the next bar. You're probably going to wait 10 bars, 20 bars to give a chance to the bears. Will the bears be able to reverse the trend? If they are, the strong bulls are not going to buy. If the bears are not able to reverse the trend and instead the market simply goes sideways, then the bulls will be willing to buy again. Again, the bulls take profits because the market might go sideways or it might reverse. And they don't want to be holding onto their trade and have all of their profits disappear. Strong bear breakout, a gap between this close and this low, this close and these lows. Another bear bar, so now the gap is this close and that low, this close and the trading range low. Possible gap, this close and that low, this close and the low before the start of the sell climax. It's a big gift. The bears were not expecting a big breakout this late in a bear trend. Weak bears who did not sell here see this as the start of a big new leg down, and they're selling late. Strong bears see this as a surprise, a gift, and they'll use it to buy back shorts. They'll certainly buy back their shorts here. And then they'll wait 5, 10, 20 bars to see if the bulls can reverse the trend. If the bulls can reverse the trend, the bears will wait to sell until the rally gets weak, and then the bears will sell again. Bulls buy because they bet the strong bears will take profits and that the market will go sideways to up for 5 or 10 bars, and it possibly could reverse. Some will buy the close of these bear bars. Some will buy above the strong bull reversal bar. We have a reversal up. You can call it a V bottom. Very strong sell-off, very abrupt reversal up. Eventually there'll be a pullback to a higher low, and there was here, and another one here, higher low. As soon as the pullback retraces at least a third of the reversal up, traders start to think about a possible higher low major trend reversal. Very tight bear channel. Most traders would not buy that. This is probably a minor reversal, not a major reversal. Now we have 2 legs down, 1 pullback 2, and this subdivided into 1 pullback 2. This would be a higher probability buy, but it's still a pretty tight channel here and a pretty tight channel here. A lot of traders will wait for a second or third entry before buying. This is a higher low major trend reversal, as is this. Here, at least you have an IOI with a bull bar, so a second entry buy. This is a higher probability buy. I would not take that buy for a major trend reversal. This one I would consider taking it, or I would wait to buy above here. It did not lead to a reversal, at least not on this chart. It might ultimately have. But at this point, the major trend reversal bulls got what they get 60% of the time, either a small win or a small loss. 40% of the time, they get an actual swing trade up. Bear trend, bull breakout, traders start to look to buy a higher or low major trend reversal here, here, or here. Smaller bear trend, strong breakout, again, major trend reversal. In this particular case, at least at the end of this chart, there was no reversal, it just continued sideways. But it is reasonable to take that buy. 40% chance you're going to get a swing up. First target this high, which is more than twice the size of the initial risk that the bulls take by taking these buys. Higher probability, instead of taking the initial major trend reversal buy, you wait to see if we get a strong bull breakout and then buy. And we did not get that. Many types of gaps. We have a gap this close and this high, this close and that high. We have another bar. Now we have a 2-bar buy climax. So the gap is now this close and that high, and that close and this high. And then we have another breakout here, a new gap, this close and that high. That gap closed immediately on the very next bar. Same thing over here. We have a bull breakout, gaps above those highs. A sell climax, one or more consecutive bear bars. We have a gap this close and that low. And then now we have a 3-bar bear breakout gap at this point between this close and that low or any of these lows. Another bear breakout. At any given moment, you look at the most recent close. The gap is between that close and the start of the bear breakout, the bar before the bear breakout began. And it's also a gap between the breakout and these prior higher lows. The bulls tried to reverse up here, but they could not close that gap. So that means this gap between this close and this low is a potential measuring gap for a measured move down. So down to here, breakout test, measured move down. Same thing here, lots of gaps. This close and these lows, this close. We have a buy climax and a pause. Another buy climax, and we have a reversal. Strong reversal down, testing the bottom of the buy climax. Sometimes when you have a buy climax or a series of buy climaxes, you get an immediate reversal down. Once you have big up, big down, you have big confusion. The market usually goes sideways, at least for a few bars. This 1-bar pause, it's a 1-bar trading range. We got a strong rally, probably going to get at least a small second leg up, and that's all we got. And then we had 7 bear bars, a reversal down, equally strong to the bull breakout. This 1-bar final flag creates a micro double top, this high and that high. Even though they're not at the same level, it's a type of double top. Most reversals involve some kind of a trading range. Here we had a bull trend, a bear breakout, and then a pullback retracing at least a third of the sell-off. This is a lower high major trend reversal after a buy climax top. Even though you can call it a V top, it still involved a small trading range. I would call it consecutive buy climaxes or parabolic wedge, 1, 2, 3, and then over here, this is a lower high major trend reversal. Bear trend, trading range, 20 or more bars, 50-50 chance you'll get a bull breakout and a reversal up, 50-50 chance you'll get a bear breakout, trend resumption down. Whenever you have a sell climax like this and then a big reversal up, you have big down, big up, creates big confusion, you're probably going to go sideways. Confusion is a hallmark of a trading range. The result usually is a trading range lasting 10 or more bars. You can get an immediate reversal up. You can get a double top and immediately sell off below this low for a measured move down. More likely, big down, big up, big confusion, you're going to go sideways at least for 5 or 10 bars. And here, the whole thing became a big trading range. Again, confusion is the hallmark of a trading range. So whenever you see something that makes you confused, you have to assume the market's in a trading range. Look to buy low, sell high, and take quick profits. Scalp. In this video, I talked about V-tops and bottoms, and I made the important point that V-tops and bottoms are almost always something else, and I therefore use some other term to describe what is taking place. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on climaxes. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on climaxes. I want to begin by talking about what I mean when I refer to something as a climactic reversal. And then climaxes often do not lead to trend reversals. They can become measuring gaps. I want to distinguish exhaustion gaps from measuring gaps. A lot of times you'll hear people on television talk about climaxes, and you immediately assume that a climax is going to lead to a reversal. In fact, most climaxes do not lead to reversals. For example, here we have a biclimax, and now we have a climactic reversal, but it only led to a 50% pullback and the bull trend resumed. You don't know that you have a climax until there is a reversal, and once the reversal begins, traders refer to it as a climactic reversal. When you get a climactic reversal, here a big sell-off and a big reversal up, they're often scary, and the climax looks like it's going to lead to a trend in the opposite direction. But that is the exception. Most of the time, the market ends up going sideways. Most climaxes are simply sharp legs in trading ranges. We have a climactic reversal up, and then a trading range. We have a small biclimax and then a reversal down. Climactic reversal down, and then a reversal up, and the market went sideways. Here we have a very strong sell-off, yet it reversed up dramatically. So this is a sell climax that led to a climactic reversal, and it was simply a leg in a trading range. It tested the bottom of the trading range, and then the trading range continued. Here we have a biclimax, and then the market reversed down. So we have a biclimax, and now we have a climactic reversal. This is a climactic reversal all the way down to here, yet did it lead to a bear trend? No, it simply led to a sideways market. Climactic reversal down, and then a trading range. So it reversed down and then a trading range. Climactic reversal down, and then sideways. We went up, and then we have a climactic reversal down and sideways. Climactic reversal down and sideways. Just like climactic reversal up, sideways, and then up and sideways. A climax can be a single very big bar, or it could be a series of smaller bars, sometimes 10 or more bars. When I use the term climax, I'm referring to a breakout that occurs late in a trend after 20 or more bars. Sometimes you get a single climax, as we have here, and other times you get a series of climaxes, like here, pullback, here, pullback, here. When you see something like this, a single big bar that reverses immediately, it's often news-related. Not always, but often news-related. And it's usually simply a test of support or resistance. And that's what this was, a very strong sell-off, but simply a test of the bottom of a trading range. Every trend bar is a climax. Every trend bar is a breakout. This is a bear breakout attempt, and it's a sell climax. Yet it immediately reversed up, and therefore you get a climactic reversal. It's a single big bear trend bar. Here we have a big bull bar. Every bull bar is a breakout and a climax. This is a breakout above this triangle or trading range. And now we have a series of 3 or 4 consecutive bull bars. This is also a climax. Here are 2 consecutive bull bars closing on their highs. That's also a climax. This is a series of biclimaxes, and this is a single biclimax with 4 consecutive big bull trend bars closing above their midpoints. Look at this. We have 6 or 7 consecutive bull bars. None of them is very big. However, on a higher time frame chart, they are maybe 1 or 2 big trend bars on that higher time frame chart. A microchannel is unsustainable. The market cannot keep doing that forever. Eventually, you'll get a pullback. A microchannel, or anything that's unsustainable, is climactic. That does not mean the market reverses. It just means it cannot continue to do that forever. Here's another bull microchannel. Climactic, the market had to pause. 7-bar bull microchannel, late in a bull trend, 20 or more bars into the trend. This is 50 bars into the bull trend. You have to be thinking that any kind of a buy climax late in the trend can be an exhaustive end of the trend. A buy climax that can lead to a reversal. Buy climax, buy climax, buy climax, buy climax. And on a higher time frame chart, this could be a single bar or 2 bars. This could be 2 or 3 bars. Every series of bull trend bars, every bull microchannel is a breakout on a higher time frame chart. Here we have 20 bars in a very tight bear channel. There are pullbacks along the way, so it's not a microchannel, but it's still a very tight channel. On a higher time frame chart, this is simply a breakout. It might be 1 or 2 consecutive big bull bear trend bars. When it occurs late in a bear trend, it could be a climactic end of the trend, a sell climax. Once the market reverses up, then you get a climactic reversal. Usually you end up going sideways. Sometimes you get an opposite trend. Most trends end with a breakout. Most trends begin with a breakout. When a breakout fails at the start of the trend, I call it a failed breakout, not a climax or a climactic reversal, even though every breakout is a climax. The market's in a bear trend lasting about 50 bars, and now we get a very strong bull breakout. Do I want to call that a climactic end of a bull trend? No, it's the start of a bull trend. I would refer to this as a failed breakout. We have a bear trend and a bull breakout above the bear trend line, and the market just stops. The rally just stops. If you want, you can call it a buy climax. It is. Every trend bar or series of trend bars is a breakout and a climax. Usually I would describe this as a breakout, and then once I see this, I would say it's a failed breakout. The market is in a broad bear channel. It's forming lower highs and lower lows. This is simply a failed reversal up within a broad bear channel, although at this point you don't know that. Once you're down here, you look back and say, oh, that was just a bull leg in a bear channel. Whenever any breakout fails, you can usually find a climax on a smaller time frame chart. This on a smaller time frame chart might be 10 bars, and it might have a small final flag, and you could call it a climax, because then if it has 10 or 20 bars on a smaller time frame chart, you have a trend lasting 10 or 20 bars, and if it reverses, you would refer to this as a buy climax and this as the climactic reversal. Very strong bull breakout. In fact, a series of buy climaxes. A buy climax here for 2 bars, and then another buy climax here, or a buy climax lasting 4 bars. It's a strong bull breakout on a 5-minute chart. We're breaking above the bear channel. However, on a higher time frame chart, like a 30-minute chart, it could simply be a failed breakout. Here's that same chart, 30-minute chart. This green box is this green box. All of these bars on the 5-minute chart create just 2 bars on the 30-minute chart, and the market's in a bear trend. This is simply a failed breakout attempt, an attempt to break above the bull channel, and it failed, and it led to a resumption of the bear trend. A very strong breakout probably will lead to a measured move. My first thought always is the open of the first bar of the buy climax to the close of the second bar of the buy climax. 60% chance we'll get a measured move up, which we did. And you can see the market stalling here, in part because of bulls taking profits. It's also a parabolic wedge top. First push, pullback, and maybe second push here, and then a pullback, and a third push. On a small time frame chart, all these tails on the tops of bars represent a wedge, a parabolic wedge on a smaller time frame chart. Trends usually begin with a breakout. Sometimes it's small, sometimes it's big. Here we have a couple bear bars leading to a bear trend. We have a reversal up, and then we have a pair of bull bars here. The bears are giving up, the bulls are becoming more confident. Do I want to call this a climax? Well, every trend bar, every series of trend bars is a climax. This is a buy climax. That is a sell climax. It did not lead to a reversal. In fact, it led to the start of a bear trend. This led to a brief reversal, so this is a climactic reversal. However, it was simply a pullback from this breakout, and the bull trend resumed. Trends often end with a breakout. For example, we have a sell climax here, a breakout, sell climax here, and then another one here. This is an exhaustive sell climax. We reversed up. The gap closed. The gap between this close and this low, that low, it closed with this reversal. And this big bear trend bar was the end of the bear trend. Here we have a big bull trend bar. In fact, it's the biggest bull trend bar of the entire trend, yet this breakout led to a climactic reversal and an end of the bull trend. The market entered a trading range. A bear breakout, it did not become a sell climactic end of the trend. It became a breakout that led to another leg down. Just because you have a climax, a breakout, a big trend bar, does not mean the trend will end. Sometimes it can lead to the beginning of a new swing down. Here we have a sell climax, a pair of bear bars, maybe a third push down, 1, 2, 3, and we have a reversal up. This is an exhaustive end of the trend, yet it did not lead to a bull trend. It simply led to a pause in the trend. The market rallied above the top of the sell climax, formed a double top with that high or this high, and then the bear trend resumed. It became a one-bar buy climax, and in this case, it was simply a bear flag. I think it's important to pay attention to gaps. Often they are exhaustion gaps. Other times they are measuring gaps. The biggest bull trend bar in a trend that has lasted 30 or 40 bars. You have to be thinking that it's a buy climax, and it is. Will it lead to a reversal in the end of the trend? Or will traders look at this and say, it's a weak rally, it's a bear flag, this might be a bull breakout of the bear flag, and maybe the trend is going to get stronger. The trend is not strong here. Where are the consecutive bull trend bars? This looks like a bull leg in a trading range. Is this an exhaustive end of this trend, or is it this bull leg in what could be a trading range converting into a bull trend? Will this be the start of a bull trend, or is it the end of this weak rally? We have a gap, the close of this bar and the high of the breakout point. There's a gap there. Will that gap close? Will we reverse down and fall below this high, that high, and even this low? Will this be an exhaustion gap, the gap between here and here? Or instead, will any pullback fail to break below these highs and the gap stays open, in which case it could be a measuring gap leading to a measured move up from this low to this high, and then from the pullback up there. At this point, we do not know if that gap will be a measuring gap leading to a bull trend or an exhaustion gap leading to a reversal down. More than 20 bars into a bull trend, maybe 30 or 40 bars. It's the biggest bull trend bar. It doesn't have to be the biggest. If it's simply one of the biggest, that is all that you need to have an increased risk of a buy climax in the end of the bull trend. However, this rally is weak, and instead of this being a climactic end of this bull trend, it could be a conversion from a weak rally into a strong bull trend. And that's what it was in this case. We have a reversal attempt, so we have a climactic reversal here, yet this low did not fall below the breakout point. And once you get this bull bar and the resumption of the bull trend, traders are beginning to think that this gap now, instead of a gap between this close and that high, it's a gap between the low of the pullback, the low of the bull flag, and that high. At this point, traders are thinking that it's probably going to be a measuring gap and that we're probably going to rally for a measured move up. Big bull trend bar. It's a breakout and a buy climax. Weak follow through for a couple bars. The bears are trying to get a climactic reversal and they want to close the gap. They want to get down to the bottom of the buy climax and then maybe fall for a measured move below that. The reversal down did not close the gap. It did not fall below the breakout point. Now we're getting breakouts here and here. That increases the chances that this gap will lead to a measured move up. The bottom of the bull trend, the top of the weak rally, and we're getting a bull breakout above a weak rally. It could be an exhaustive end of the trend, but once we start to go up here and here, it becomes more likely that this gap is going to lead to a measured move up. That's the measured move, and look what happened. The market got very close to that line and then paused. That means a lot of bulls were looking to take profits at a measured move up. And bear scalpers will sell there as well, especially since we're getting bad follow through here, tail here, tail here. Bears are starting to sell above bars, betting that we'll get a pullback around the measured move target. We have another breakout here and a reversal attempt here. And again, look at the low of this bar, go to the left, and there's a gap. This low did not fall below that high. Even if it fell a little bit below the high, you can still get a measured move up. Where did this leg up begin? It began right here. So possible measured move up from the bottom of this leg up, which is right here, to the gap, and there's the measured move target, and look what happened. Profit takers. Bulls look at measured move projections to take partial profits. My original measured move was from the middle of the gap, this high to that low. A lot of computers use the bottom of the gap. In other words, the top of the bull leg. So the bottom of the bull trend to the top of the bull trend, and then they take a measured move up from there. And you can see profit taking here, profit taking there. And then the ultimate high, turns out, was based upon a measured move using the middle of the gap, the orange line, instead of the red line. I initially look at the red line, the top of the bear trend, even though the gap is up here and the middle of the gap is here. I look at both. If it goes above the red line, then I look for a reversal down based upon the orange line, the middle of the gap. We're in a bear trend, and now we have a sell climax here and an even bigger sell climax here. Here's the breakout point. Now we're starting to reverse up. So we're getting a climactic reversal, a sell climax and a reversal. Yet, will the reversal close the gap? The gap originally was from this close to that breakout point, and now it's from the breakout point to this high. One of the biggest bear trend bars, 20 or more bars into the bear trend, increased risk of an exhaustive end of the trend, but it still could be a breakout into an even stronger bear trend, and it could be a measuring gap. I call the bar itself a measuring gap, but you could call the actual gap, the pullback breakout point, as the gap. But to me, I'm looking at that bar and I'm saying it's either an exhaustion gap or a measuring gap. I call the bar a gap even though there's no gap. Initially, I want to look at a measured move based upon the start of the current leg to the end of the current leg. We broke below that, possible measured move down here. If it falls below there, then I'll look at a measured move from the top of the bear trend up here. We have a bear breakout bar, and the next bar is a bear bar. That's good follow through. That increases the chances that we're going lower. We have 3 bear follow through bars, good for the bears. We have an attempt here to close the gap, but we're failing, a micro double top and starting to turn down again, good for the bears. The pullback did not close the gap, so this is simply a breakout test, a test of the breakout point. The market fell for the measured move, and you can see profit taking and a small sell climax, and this is a climactic reversal. Yet it looks like it's failing around the top of the most recent sell climax, and now we have a double top bear flag with this high and that high, or the top of the sell climax and that high. Bears will sell below this bar, looking for a continued bear trend. A bear breakout, another bear breakout. Here's the breakout point. The market went above the breakout point, so the gap closed, but it still could be a continued bear trend. Whenever the pullback overlaps the breakout point, if the pullback does not overlap it by very much, I call it a negative gap, and it sometimes also leads to a measured move. From the top of the bear trend to the middle of that gap, maybe the market will fall for a measured move. This is overlapping by more than what typically happens if you're going to get a measured move down. but it still could result in a measured move down. At this point, it is an exhaustion gap. This sell climax, the gap between this close and that breakout point, it closed over here. This is an exhaustive sell climax, but that does not mean the reversal will lead to a bull trend. We're still in a bear trend, and the reversal up has terrible follow-through. Because we have a negative gap, slight overlap of the pullback and the breakout point, we could get a measured move down from the midpoint of the overlap. I still call that a possible gap, the high of the pullback bar, the low of the breakout point, and the measured move might come from the top of this current bear leg or the top of the bear trend. And you can see what happened when the market got down to the measured move target. We have a sell climax and a reversal. We have profit taking. The gap between this low and that high closed. It became an exhaustion gap. This is a climactic reversal that led to an actual trend reversal. We have a big bear trend bar, so it's a breakout, but it's occurring 20 or more bars into a bear trend. Here, it's occurring 50 or 60 bars into a bear trend. Whenever I see the biggest trend bar late in a trend, the odds are it'll be an exhaustion gap, not a measuring gap. It sometimes is a measuring gap, but 60% of the time it ends up as an exhaustion gap and the gap closes. Initially, the gap is between this close and any of these lows, the low of the bar before or any of the lows of the trading range. And then once you get a pullback and a resumption of the bear trend, the gap is then between the top of the pullback, the top of the bear flag, and these lows. Here we have a sell climax and a climactic reversal, and it led to a trading range. Ultimately, we got a trend reversal. Whenever you have a sell climax like this, late in a bear trend, and you start to get a reversal, the first target is always a move just above the top of the sell climax. The bears want a double top with that high and this high, and they want to break below the neckline and a measured move down. The bulls want a break above the double top and a measured move up. The bulls got much more than a measured move up here. Strong breakout, 2 bars here, probably going to get a measured move up, maybe based upon the open of the first bar to the close of the final bar. It's a 2-bar buy climax, and the market had some profit taking at the measured move target. We have a bull trend, and now we have the biggest bull trend bar late in a bull trend, after the bull trend has gone on for 20 or more bars. More likely an exhaustive end of the trend, less likely a measuring gap and a measured move up. Whenever I see the biggest bull bar or the biggest 2, 3, or 4 consecutive bull bars occurring late in a bull trend, I assume the odds are it's an exhaustive end of the trend and that the market would either then enter a trading range or an opposite trend. Initially, the gap is this close to that high. We have a bull flag here, small double bottom bull flag. So then the gap is the bottom of the bull flag, maybe that low and this high. And then we get a climactic reversal and the gap closed. I would refer to this bar as an exhaustion gap or an exhaustion gap bar. On the way up, we have a breakout here. The low of this bar, the high of that bar, no overlap, possible measuring gap. And you can see bulls took profits there. And part of this bull trend bar was caused by a buy vacuum test of the measured move target. And there's also a top of a channel here, and that is also a magnet, and the market raced up to get to the top of the channel. We have a pullback here, the bottom of a bull flag. I always look to the left, and is it testing something? Maybe it's testing this high, so this might be a measuring gap. Measured move up, either based upon the midpoint of the breakout and the bull flag pullback, or the top of the breakout point. I usually first look at a measured move based upon the top of the breakout point. And if it goes beyond that, then I look at a measured move based upon the midpoint of the gap. This is the measured move based upon the midpoint of the gap. When the market gets there, I want to see how it behaves. If I'm long, I'm going to take at least partial profits, maybe full profits. And if I'm not long, I start thinking about possibly selling for a scalp. When the bulls see a big bar like this late in a trend, they're excited. What a great opportunity to take profits. They have a surprise move and they sell. The bulls sell to take partial profits. Sometimes they sell to take full profits. They know that whenever you get a big bull trend bar late in a bull trend, the gap is probably going to close. And therefore, it's a great opportunity to take profits. And you wait to see if the bears simply test down, close the gap, and not create a bear trend, or if the bears look reasonably strong and you start to see a lot of bear bodies, in which case the bulls wait to buy. The bulls are not going to take profits here if they think the market's just going to pull back one bar, because then they have to buy again, and it might be hard to buy again. They're only taking profits because they think the market may correct for 10 bars and 2 legs, and possibly lead to a reversal after a big bull trend bar late in a bull trend. They want to see what the bears can do. They wait 5 or 10 bars to see if the bears look reasonably strong, and then the bulls wait even more. If the bears, on the other hand, do not look strong, the bulls will buy, betting that the correction is simply a bull flag. Nobody left to buy at this high price. The strong bears are going to sell, and they're never going to buy back their shorts. The weak bears, they sold here, and they're buying back their shorts here, so no more weak bears left. The weak bulls are buying up here, but there are not very many of them, and the strong bulls are taking profits. Therefore, there's nobody left to buy. And you get a pullback and possibly a reversal. The strong bulls just took profits. They're not going to buy again a bar or two later. They're going to wait 10 or more bars before they buy again. And maybe they buy here, a very tight channel. Most of them would probably wait, maybe buy here or buy here. The strong bears know the bulls will take profits, and the bears will start to sell. Maybe they'll sell above bars, sell closes, sell below bars. If they do, they probably have to use a wide stop, maybe based upon the height of this breakout, so the stop would be somewhere up here, and they'll look to add on higher. The safest way to sell would be with a stop order. Here we have a second entry short. Here's the first entry, the market going below this bar. The bulls trying to resume again. We have a micro double top here, we have a small double top here, and now we have a failed breakout for the second time. The breakout failed here, the bulls tried to resume, and now it's failing a second time. That's a higher probability short. Traders who sell early like this, some of them, after a second entry short, would put a stop above this bar or above that bar. Very low risk, very big reward. That always means the probability is low, or relatively low. Higher probability to sell after you've seen a strong reversal down. At this point, we've been in a bear tight channel for about 10 bars, and it's higher probability to sell here or below this bear reversal. This is a double top bear flag, this high, and maybe that bull bar. Or you can simply say 2 legs up, 1 pullback 2, and a decent bear bar. Very tight bear channel, probably minor reversal, and we're going lower. A big bear trend bar, therefore a breakout and a climax, occurring 20 or more bars into a bear trend. Here it's occurring 60 or 70 bars into the bear trend. Most likely the gap between this close and that low, or any of these lows, will close. And therefore this is probably going to be an exhaustion gap bar. I simply call it an exhaustion gap. Less likely, it'll be a measuring gap, leading to a measured move down. You can see the high of this bar slightly overlapped the low of that bar. So we have a negative gap, and we could have a measured move down. But the biggest bear trend bar late in the trend like this, if you're a strong bear, what are you going to do? You're going to use it to take profits. You're going to say, wow, what a big gift. I'm going to take profits. I'll wait 10 bars, 20 bars, 5 bars to see if the bulls can get a reversal. If the bulls fail and we simply go sideways, then I'll sell again. If, on the other hand, the bulls aren't able to get a pretty good reversal, I won't sell. I'll just wait until I get a sell setup. And here, there never was a sell setup. We have a trading range and a breakout. It fell to about a measured move down. A reversal down here, a reversal down here, so I can draw a bear trend line. I can then create a parallel and drag it to a low that would contain all of the prices. And look what happens. We're at a measured move target in the bottom of a channel, buyers. The bears tried to resume again, but we reversed up again a second time. The bears have been short and they've been selling all the way down. They're looking for reasons to take profits. When you see a big breakout like this late in the bear trend, it's probably an exhaustive end of the move. We're probably going to go sideways, or we might reverse. When the bears see that close, they buy. They buy back their shorts, and they wait. The weak bears might sell here, thinking that finally the market's clearly strong. But if they do, they're going to get trapped. There are just not enough weak bears to keep the trend going. Weak bulls who have been buying along here, hoping for reversals, they're giving up. And they're part of the reason why the market sold off like this. Strong bulls, they see this and they understand what's going on. They know the strong bears are going to buy back shorts. The strong bulls buy, looking for at least a scalp up, maybe a test of the top of the sell climax. The strong bears, they're not going to buy if they're planning on selling again a bar or two later. They're buying because they think the market's going to go sideways to up for maybe 10 bars and 2 legs. There's no one left to sell at this price. The strong bears are buying. There are not enough weak bears to drive the market down. The weak bulls gave up and caused this bar, or at least contributed to this bar, and they're gone. And all that's left are strong bulls buying for a scalp and strong bears buying to take profits. A brief opportunity for the bulls to buy at a very low price with not much risk. The bulls and bears are both buying, expecting maybe 2 legs, 10 bars, sideways to up. When the rally is reasonably strong like this, the bears are not going to sell again. The bulls see that and they buy. They expect this attempt at bear trend resumption to fail. So the bulls buy, looking for another leg up. The bulls who buy this close or this reversal up or this or that, the risk is not that great. Stop maybe down here. They're bulls looking for great risk reward. Big reward, low risk. That always comes with low probability. Buying this reversal or these reversals, not a high probability that you're going to make money. However, if you buy after a strong reversal up here or buy closes here, high probability that the market will go at least a little bit higher, but the stop is further away. Buying late after you see the strong breakout, higher probability that you make money, but the risk-reward ratio is worse. The stop is usually further away, bigger risk. There's less profit remaining in the trade, so smaller reward. It doesn't matter whether you buy down here with the good risk-reward ratio and low probability, or up here with the good probability and the bad risk-reward. Both are profitable strategies. I began by talking about climactic reversals, a big trend bar late in a trend leading to a reversal. Usually it leads to a sideways move, but sometimes it leads to an opposite trend. I finished up by talking about gaps, an exhaustion gap, a big trend bar late in a trend leading to an end of the trend, or measuring gaps, a big trend bar late in a trend leading to a resumption of the trend and a measured move. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on climaxes. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on climaxes. I'm going to begin by talking about consecutive climaxes, where you have one climax and then you have another climax before you have a reversal. It's important to remember that every trend bar is a breakout and a climax. A climax does not necessarily mean a reversal. A big bull trend bar, a buy climax. Another buy climax. Another buy climax. Here it's consecutive bull trend bars. And then finally another climax at the top. Ultimately, the market pulled back, went sideways for a long time, and then there was a little bit of a reversal. This is a series of buy climaxes, and when they occur with very little pullback after each climax, the market often forms a wedge or a parabolic wedge. Also, it often moves for a measured move. I have a top here and a pullback, and then I have another climax and a small reversal down, and then another reversal down. This is a parabolic wedge at this point. Sometimes you get a fourth push, which you have here. Other computers will say, well, this is such a strong breakout, the market is starting the count over again. So this is the first push, not this. You have a first push, a second push, and a third push. In any case, whenever you see a series of 3 or more climaxes in a very tight channel, and then you get a reversal attempt, it is a parabolic wedge. A biclimax ends when the next bar is either a bear bar, as it is here, or a small bar here. Here we have a bigger bull bar compared to this, and then another bigger bull bar. I view these two bars as a breakout, and therefore a climax. This bar has a big tail on top, so I think of it as not part of the climax. This is the biclimax, and that's the bar that ended the climax. A big bull trend bar here, relatively big, and then you have a bull trend bar here. I would say this is the climax, and that bar means that the climax ended with this bar. Whenever the market's in a channel, even a very tight channel, there's a 75% chance that a bull breakout above a bull channel will lead to a reversal and a test of the bottom of the channel. If I were to draw the bottom of the channel, it would be very tight. It's not much of an accomplishment for the market to go from the top of the channel to the bottom of the channel. Whenever I see a bull channel, I'm assuming 75% chance the market will break below the bottom of the channel. So any bull channel, even a very strong one like this, in a very tight channel, is a bear flag. I say that because I expect a bear breakout 75% of the time. Only 25% of the time will the market break strongly above the top of the channel and then enter another breakout phase. For example, like this, another breakout and then another channel. If you have a bull channel, you're probably going to get a bear breakout and not a new breakout and then another bull channel. The opposite is true for a bear channel. Every bear channel, for example, here's a bear channel. Every bear channel is a bull flag. 75% chance it'll break above the top of the bear channel. There are always bears selling at the prior high. Bears are scaling into shorts. So they'll sell with a limit order at this high or above the high, and the same with here as well. These are, for the most part, weak bears trying to pick a top. They're afraid of losing too much money, and they believe that if they sell at the high, maybe the market will reverse immediately and they'll have very little risk. Whenever a trader takes a trade that has very little risk, he's going to lose money the majority of the time. Anytime you're trying to create a trade with a very low risk, you're trying to create a trade with a very good risk-reward ratio, that always has to have a low probability. If you take a low-risk trade, you're probably going to lose. And if the risk is too small, the probability of winning is so small, it's not a profitable strategy. You have bears selling here, weak bears, and they're forced to buy. They sell above this bar or above that bar, and they're forced to buy back their shorts. Strong bears, on the other hand, might be selling this high as well, or that high as well. Probably not this high, but maybe this high when the bars are getting smaller, and we've already had 2 or 3 biclimaxes. 1, 2, 3. Strong bears will start selling prior highs, and they'll scale in, but they're never going to buy back their shorts. They can keep scaling in indefinitely, and therefore, because they're never going to be forced into buying back their shorts, they're never going to get squeezed out, and you're not going to get a biclimax due to strong bears buying. When you get a biclimax like this, it's in part due to weak bears buying. Bears selling this high, hoping for a top with very little risk, and they have to cover as the market races up, and the same here. Strong bears are not going to buy back their shorts. Eventually what happens is there are no more bears willing to buy back their shorts. All you're left with are the strong bears. And the strong bulls, they bought down here. They're not buying up here. They look at this as a gift. The market rallied very quickly, very far above their entry price, anywhere down in here, and they're going to start taking profits. So the strong bulls are selling. The only buyers left are the weak bulls, the bulls who did not buy this because the stop was too far. And then they finally bought here because the stop is closer, and there are not enough weak bulls left to lift the market up. The strong bulls are selling, the market goes down. The strong bears are selling, the market goes down. And that's what happens when you get a series of climaxes. 1, 2, 3, 4 consecutive biclimaxes. You have to assume the market will soon start to pull back. And the strong bulls who sold here are not looking to buy back on the next bar. They're concerned that it's so climactic there might be a reversal. They'll wait at least 5 or 10 bars before looking to buy again. And if they're not convinced that the swing down has ended, they're not going to buy. And that's what took place here. 7 or 8 bear bars, the bulls did not buy. They expect a second leg down. Second leg down, but a bear breakout, they expect more down again. So not much buying by the strong bulls either. Once you run out of trapped bears and the strong bulls stop buying, the market has to go lower to find traders willing to buy. Those strong bulls are only going to buy after they see evidence that the strong bears are taking profits. When you get 7 bars down like this, do you think the bears are buying back their shorts? No, they're expecting a second leg down, so they're looking for a rally to sell. The bulls know that, so the bulls are not eager to buy, and the result is very weak buying, very small bars, tight trading range. Weak bulls are always buying, hoping that they're buying with very little risk. But they do not have enough money to create a significant move. They will not overwhelm the strong bears. In general, whenever you have any significant reversal, here we're talking about consecutive buy climaxes and a parabolic wedge, and we're starting to reverse down. A general rule is wait 10 bars and 2 legs, TBTL, 10 bars and 2 legs before looking to buy again, because that's pretty much what the strong bulls will do as well. When the first leg down is reasonably strong like this, an 8-bar bear microchannel, the strong bulls are not going to buy. You get some weak bulls buying, you have some strong bears taking partial profits, and you get a bounce. But the bulls who did not exit during the sell-off will exit on the bounce, a 50% pullback, and the bears who did not sell will sell on the bounce as well, and the result is you get at least one more leg down. The strong bulls want to wait at least 10 bars and 2 legs because that's typically what follows a series of buy climaxes. And if they see 10 bars, at this point they have 10 bars, but they only have 1 leg, so they're not going to buy. At this point, they have 2 legs down, 1, pullback 2, and far more than 10 bars. They probably have 50 bars, but they have a strong bear breakout. They're also not going to buy here either. At a minimum, they're going to wait 10 bars and 2 legs in general before they'll think about buying again. After 8 bars down like this, the strong bulls believe that the bears will sell more on any bounce, expecting another leg down. On the other hand, if the strong bulls think that the sell-off is not very good and that there's not enough selling by the strong bears and the market has had a couple legs down, that's not the case here, the bulls will buy, expecting another leg up. We have a bull trend bar and therefore a buy climax. Here we have a bull trend and we have a bull trend bar, so that's the buy climax. We have a series of bull trend bars here, another buy climax. 2 big bull trend bars, another bull trend bar. We have a series of buy climaxes, and they are in a channel. I can draw a line above, I can draw a line below. A bull channel is a bear flag. "25% chance the bulls will get a breakout above the channel and then start another market cycle. Bull breakout and then channel up. 75% chance a bull breakout attempt will fail and the market will break below the bottom of the channel, at least a little bit. 75% chance the market will break below the channel either by going down or by simply going sideways. 25% chance you'll get a bull breakout and another leg up. If you do get the bull breakout, you have to be thinking about a possible measured move. A bull channel is a bear flag. If you get a bull breakout above the bear flag, you'll probably rally for a measured move up. And that's what we have. We have a bull channel. The market tried to go sideways or down to break below the bottom of the channel. And instead we got this, a big bull breakout and follow through. Probably a measuring gap, this low and that high. Traders will look for a measured move up from here or here to here, up to this general area. Whenever you have a strong breakout, it doesn't matter, a strong breakout of a trading range or a strong breakout above a bull channel, the market cycle begins over again. A breakout and then a channel and then a trading range again. We have a breakout and then a small bar, and then another breakout, and then a small bar, and then another breakout. This is a parabolic wedge top. The market tried to reverse down. We broke out again, and we went sideways. We tried to resume up again, and it's within a trading range. This is consecutive tops. We have a top attempt here, and we have another breakout, another top attempt, and now we have another top attempt, and the result was a trading range. A breakout like this is a low probability event. Whenever something is unlikely to happen, but does happen, both the bulls and the bears are trapped. Both thought the market would go sideways to down. Instead, it went up. The bears who were selling prior highs now find themselves in a losing position, and when they see a pair of consecutive bull trend bars like this, they know we're probably rallying from a measured move up. They're hoping for any pullback like this or like this to buy back their shorts, to reduce their loss. And because the bears are buying, any small pullback will lead to a rally. A pullback leads to a rally. You'll have bulls who thought this was going to top out, but then they see this and they say, we're going higher. They're going to look at any pullback as an opportunity to buy for at least a small second leg up. They'll buy below this bar, they'll buy above that bar, second leg up. Here we now have a double bottom bull flag, and they'll buy above this bar, or they'll simply buy at that low, looking for at least another leg up. Bulls and bears are both buying. The probability is, after you have a strong breakout like this, you're going to get a second leg up. This might be a small second leg, pullback second leg, or pullback second leg. Consecutive buy climaxes, here we have 4 of them, 1, 2, 3, 4. It's a type of a wedge top. And now we're getting a bull breakout above a wedge top. Usually, if you get a strong bull breakout above a wedge top, or above any kind of a bear flag, the market will rally for some kind of a measured move up. Here's the top of the bear flag, the top of the wedge, and this is a measured move. And you can see what happened when the market got there. It pulled back, in part because bulls were taking profits, in part because the bears expected bulls to take profits, and the bears started selling as well for a scalp down. Four bull trend bars, a little climax here. You can call all of this a buy climax, a small climax here. Every trend bar is a climax. A big bull trend bar, a climax, a trend bar, a climax, a trend bar, a climax. At some point, there's no one left to buy at this price at this time, and the strong bulls will take profits, the strong bears begin to short. Usually, after you get a series of consecutive buy climaxes, the market goes sideways, and then it decides whether it will resume up or reverse down. Consecutive buy climaxes, you have to assume at some point you'll get 10 bars, 2 legs, sideways to down. That's the minimum objective. Here's one leg, the bull trend resumed, second leg, so we have 2 legs sideways here. You could say the buy climax ended here, and this is 1 leg down. You don't always get a second leg down, maybe we will. 20-bar trading range after consecutive buy climaxes. This is a buy climax as well, and this is a small buy climax. But we started to go sideways here, small bars, doji bars, prominent tails, small bodies. After the market goes sideways for 20 or more bars, this is probably 30 bars, the market's in breakout mode. There's about a 50-50 chance that you'll get a reversal down, and a 50-50 chance you'll get trend resumption up. For the bulls, they see a double bottom bull flag, and for the bears, they see a lower high major trend reversal, or a head and shoulders top, left shoulder, head, right shoulder. The bears do not have consecutive big bear trend bars here or here. They're concerned that they are not able to reverse the market. If enough bears believe that they are unable to turn the market down, they'll start buying back their shorts. At this point, it's still neutral. We still don't know if the bears will give up and the bulls will buy and will get trend resumption up. Every trading range has both a buy signal and a sell signal. They're both equally good. In general, there's always a slightly higher probability that the trend will resume, but after you get to 20 or 30 bars, the probability is almost 50-50 for trend resumption up and trend reversal down. After a lot of bars, the bulls start getting confident again, and they try hard to get their trend resumption up. At this point, it's still neutral. But you get a bull bar here and a second bull bar here. Traders believe that we're going up. We're going to get trend resumption up. The bears are giving up on these bars, these two bars here, and bulls are buying aggressively. You can see the open of this bar is at or above the close of this bar. The low of this bar barely dipped below the high of this bar. That means bulls are buying aggressively. The same here and the same here. The bears are giving up. These two bars signify the bears giving up, and the bulls are buying aggressively for at least a measured move up based upon the height of the trading range. Now we have an even bigger buy climax. Here we have a 4 bull bar buy climax. It's bigger than this buy climax or any of these prior buy climaxes. Whenever you have the biggest buy climax occurring 20 or more bars into a trend, here it's 100 bars into the trend. Chances are it's going to be an exhaustive end of the trend and not the start of a new, even stronger trend. This is probably going to be an exhaustion gap. We have a pullback here. We're going sideways. The gap right now is this low and that high. Probably the gap will close, which it did over here. Usually the market comes all the way down to the bottom of the buy climax. In this particular case, it simply went sideways. You can draw a channel. We have a reversal down, a reversal down. That allows us to draw a channel. And part of the reason why this went up so quickly is everyone knew it would get to the top of the channel, and everyone knew it would reach a measured move based upon the height of the trading range. So you had two magnets here. The bears bought back their shorts early on, all the way up for that matter, and they did not want to sell again until the market got to resistance, the top of the channel and the measured move target. And the bulls were buying aggressively, knowing that bears would not sell, but once it got to the target, the bulls stopped buying. Strong enough breakout, chances are there'll be at least a small second leg up, but not necessarily more than that. And you can see what happened when the market had that second leg up. The bears sold aggressively above the channel and above the measured move target, and the bulls saw this as a great opportunity to take profits. Bears and bulls sold, and we went sideways to down. Strong rally, probably a second leg up, and we got a second reversal down. First reversal here, this tail, and the second reversal, a big tail and a bear body, a micro double top. Two attempts to break above resistance, both failed. Probably we'll get at least 10 bars, two legs sideways to down. Bulls exhausted. They want to wait at least 10 bars and two legs, one leg, pull back, two legs, before they buy again. Just like here, they were exhausted and they waited. Three reversals down, here or here, and then here and here. It's a triangle, breakout mode. And the bulls got a breakout. But look at this breakout. Does it look like this? No, it's small bars, doji bars. This probably is a bull leg and what will end up in a trading range. So this probably eventually will trade back down here without going much higher. Strongest bull breakout, 20 or more bars into a bull trend. Probably an exhaustion gap. This is about 100 bars into a bull trend. We have consecutive buy climaxes all the way up. We also have a wedge top, 3 pushes up, a bull breakout above a bull channel, twice trying to break out, both times reversing down. This is probably an exhaustion gap. The gap initially is this close and that high, and then this close, and then this close and that high. Then we get a pullback here. The gap now is this low or that low and this high. And eventually the market fell below the breakout point and the gap closed. That means this rally became an exhaustion gap rather than a measuring gap. You had bears selling above bars. They sold above here. They made money. They sold above here and they panicked. They realized that they were selling into a strong breakout. The weak bears bought back their shorts. You had weak bulls who had been waiting for confidence that the market was going higher, and they finally buy. They buy at the top. When the weak bears are all gone and they've all bought back their shorts and the weak bulls are finally buying near the top, there's no one left to buy. The strong bulls bought down here, and the strong bears will look at this and say, this is consecutive buy climaxes. We're at the top of a channel. We're at a measured move. What a great opportunity to sell, at least for a scalp. The strong bulls are selling to take profits. The strong bears are selling for a scalp. There are no more weak bears left to buy. They've already been stopped out as the market rallied. And the weak bulls, there are not enough of them to make the market go higher. Bulls see this as a gift. Strong breakout, they expect at least a little bit more up, but they also see the location, top of a channel, measured move. As the market's going up, they sell. The strong bulls sell above this high. The weak bulls are buying above this high, and the strong bears are selling above that high as well. And the result was a big reversal bar. And it led to 10 bars down and 20 to 30 bars sideways. Again, the strong bears see the same thing as the bulls, and they see this resistance as a great opportunity to sell, at least for a scalp, maybe for a swing. They know this is more likely an exhaustive end of a trend instead of a breakout and an acceleration into an even stronger trend. Every trend bar, every series of trend bars is a breakout and a climax. We have two bear bars closing on their lows, good size, sell climax, small sell climax here, sell climax here, a little bit here, here, here. We have a series of sell climaxes without much pullback. Usually you run out of traders willing to sell. The weak bulls keep buying, 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 and they're giving up, giving up, giving up. And at some point they stop buying. And the weak bears, they see the breakout and they say, now's the time to sell. And they keep selling at the lows. They are not enough to keep the trend going down. The strong bulls see the consecutive sell climaxes, and they know the odds are the market will soon go up or sideways for 10 bars and 2 legs at a minimum. And the strong bears, they sold up here. At some point, they start taking profits at prior lows. And you can see we have a breakout below this low, but it pulled back above the low. We have a breakout below this low, and it pulled back above that breakout point. The strong bears are starting to take profits. They know that when you have a series of consecutive sell climaxes, the market's probably going to go up for at least 10 bars and 2 legs, and they buy back their shorts, looking to sell higher. If the reversal up is strong enough, they'll keep waiting to sell again. And the strong bulls, they're never going to give up. They're buying these lows, every new low, they're buying more and more and more, confident that after a series of consecutive sell climaxes, we're going to enter a trading range or get a reversal. A climax ends when there is some kind of a pause bar. Here a doji bar, here a bull bar, a bull bar, a bull bar. This is the climax, and this bar means that the climax has ended with this bar. Bear channel, I don't have a channel drawn in there, but a bear channel is a bull flag. 25% chance you'll get a new breakout and then a new market cycle down, a breakout and then another channel down. 75% chance you're going to break above the top of the bear channel. A bear channel is a bull flag. A series of sell climaxes often ends with some kind of a wedge, 3 pushes down, 1, 2, 3, sometimes a parabolic wedge, and usually around a measured move. Look to the left. Are there any gaps? We have a breakout here. These pullbacks did not go above that breakout point. This bar might be a measuring gap. Maybe from the start of this bear leg, possibly from the start of the bear trend. But in any case, this bear leg, it led to a measured move down. If it fell below that, then I would look at a measured move based upon the top of the bear trend to this gap. Measuring gap, 3 pushes down, 1, 2, 3. Very big breakout bar. We tried to bottom here, and we got a very big breakout, possibly 3 pushes down, 1, 2, 3, to a wedge bottom, and a measured move. If the strong bears believe that bulls will only buy lower, the bears will keep selling. They expect another leg down. But they also know eventually the strong bulls will buy, and they'll keep buying and never stop buying. The weak bulls keep buying and giving up. They buy, they give up. They buy, they give up. And they are helping drive the market down. Eventually, there will not be enough bulls selling to drive the market down. There will not be enough weak bears left selling, and the strong bears will stop selling, and they're only willing to sell higher. And the strong bulls will take over the market, and that's what took place here.
You can call this a lower low major trend reversal. We have a bear trend, a weak bull breakout, and a lower low. It's a second entry buy. First entry did not go very far. And now we have a second bull bar closing on its high. This is a reasonable buy for the bulls, hoping for at least a test of this high, maybe a couple legs up. You can also call it a wedge bottom. We have a breakout, pullback, second push, pullback, third push. It's a reasonable buy. At this point, we have 5 consecutive bull bars. And at this point, we have, 7 bars without a bear bar? Chances are we're going at least a little bit higher. If the bulls think the bears are weak, they'll keep holding on to their longs. Once you get 3 or 4 bear bars, especially after a wedge bottom and a second entry buy, the market's probably transitioning at least into a trading range. The bulls think the market's going to go higher after 3 or 4 consecutive bull bars. They're going to start buying below bars. They'll buy below this bar. A 10-bar bull micro channel, betting that they'll get at least a small second leg up. And at this point, the bulls are wondering if this is a reasonable higher low major trend reversal. They'll buy above this bar or above this bar or that bar, betting on a second leg up. Leg 1, pullback, leg 2. We have 10 bars up without a pullback. That means the bears are not interested in selling at this price. The market has to go higher before it'll find sellers. At some point, the bulls will decide it's high enough and they'll take profits, and the bears will think that the price is a good value to sell. But that did not happen on this chart. At a minimum, after any kind of major reversal or a series of sell climaxes, the market has to go 10 bars, 2 legs sideways to up before the bulls will stop buying and before the bears will think about selling. It sometimes can go much further. This is about 40 bars up, and we still do not have much selling. The bears usually wait at least 10 bars and 2 legs before they sell, and if they see the rally being reasonably strong, they're still not going to sell. They'll assume that the market has to go higher. As the market's going up 3, 4, 5 consecutive bull bars, traders conclude there's no one left to sell at this price, and it has to go higher to find sellers. Will there be sellers here? Very tight bull channel. Probably traders will buy the first reversal back down and will probably get a second leg up. There are always bulls buying at prior lows, looking for at least a scalp. A lot of these traders are weak bulls trying to buy and risk very little, and eventually they give up and they stop buying. They buy here and they see the market going down, they panic and they sell. They buy at this low and they see it going down more, they panic and they sell. There are no more weak bulls left. They stop buying. Eventually what you're left with are strong bulls. Some of them are buying here and they're buying more aggressively and more confidently below these bars, and they're never going to sell out of their longs. They're confident that the market will eventually reverse and they'll make a profit. I talked about consecutive climaxes. Every trend bar is a breakout and a climax. If you get a series of them, the market usually gets exhausted and has to go sideways and often reverses. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on climaxes. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on climaxes. I want to make an important point about climaxes being influenced by option selling firms, or not always entirely caused by bears. Finally, I'll talk about consecutive climaxes that fail. We have a series of sell climaxes. A lot of this selling is caused by institutions believing the market's going to go down. A lot of it is caused by institutions that have long positions and they think the market's going down and they're liquidating their longs. They're selling out of longs. Some institutions specialize in selling options. For example, a lot of funds buy puts to protect their stocks against losses. If the market goes down and they're holding a put, if they're long a put, the put will go up in value, offsetting the losses that they get from their stocks. They're institutions that specialize in selling options. That's all they do, is they sell options. The value of the put increases as the stock goes down. Or in this case, let's say we're talking about the SPDR or an ETF, the SPY, or the stock market in general. If the underlying is going down, the stock is going down, the value of the put increases, but it's not proportional. The rate of increase of the put is called the delta, and as the market falls further and further, the value of the put accelerates upward. Its value increases faster than the market is falling. And as a result, those institutions that specialize in selling puts have losses that are accelerating as the market falls. Gamma is a measure of how fast the delta is changing. You don't need to know this. But as the market's falling, what's happening is the delta is increasing rapidly. The puts are increasing rapidly, faster than the market is falling. The result is those option selling firms are getting a lot of losses. Those puts that they sold are rapidly increasing in value. Those option firms don't want to lose money. They can't buy back their puts. They don't have control over that. What they can do instead is sell the underlying to offset the losses in the puts. As the market's falling, those option selling firms are losing money. The puts are increasing in value. They sold those puts. The firms that bought those puts are making money. The option selling firms need to do something to control their losses. Let's say this is the SPDR or the stock market. What those firms will do is sell stock or sell the SPDR or sell the underlying. And the result is those option selling firms are trying to reduce their losses by selling the underlying. If they sold puts against the stock market, there are many different ways to do that. They need to sell stock to offset the losses that they're getting with their puts. When you start to get sell climaxes, a lot of that is due to option selling firms selling the underlying, selling the stock market, to try to offset the losses that they're getting in their puts. Those firms are not bearish. They don't care. They don't care if the market's going up or down. All they care about is whether they can make money by selling puts and selling calls. If a market has a series of sell climaxes like this, part of the selling is from firms selling stock because they're no longer as bullish as they were, and part of the selling is due to option selling firms hedging their losses in their short puts by selling the underlying, by selling stocks. When you see a very severe series of sell climaxes, sometimes the sell-off can be 50% caused by option selling firms hedging their puts. When you have a series of sell climaxes like this, it's not necessarily as bearish as it appears. Again, the option selling firms, they're not bearish or bullish. They just know that if the market is falling, they have to sell stock. And that means that maybe half of a severe sell climax is caused by option selling firms hedging their short puts. They're not bearish. So half of this sell-off could be caused by institutions that are not bearish at all. And therefore, consecutive sell climaxes often is far less bearish than what you think. Markets going down, the puts are increasing in value. The firms that sold those puts are losing money. The easiest way to hedge their losses, reduce their losses, is to sell the underlying stocks or futures. And that results in increased selling, more sell climaxes. Again, as much as 50% of a sell climax or a series of sell climaxes can be caused by institutions hedging their short puts rather than by traders being bearish. So consecutive sell climaxes often is not as bearish as you'd think. You have to wait until the sell climax is over and see what happens. If it's truly bearish, the market will continue down. If it's not as bearish as you think, and if it's due in large part due to option selling firms hedging, the market will either go sideways or go up. If you see this after a series of sell climaxes, you have to assume the market is not as bearish as you think, and therefore a lot of the selling was simply hedging by option selling institutions. There's a difference between sell climaxes and buy climaxes. Most stock is being owned by institutions. There are some stock that is held by institutions that are short, but most stock is held by institutions believing the stock will go up. Most of those firms buying want to buy value. They want to buy pullbacks. There are fewer firms willing to buy breakouts at the top of strong rallies. And the result is buy climaxes tend to be less impressive than sell climaxes. Firms who buy puts, for the most part, are firms who own stock, and they're still bullish, but they want to protect themselves against losses, against the market going down, without selling their stock. Most firms that buy calls are bulls. Firms that buy puts are bulls as well, protecting their long positions. Firms that buy calls are bulls. They're buying calls instead of stock because they want to make a bet that the market's going higher with smaller risk. The firms that sell options, for example, selling calls, they do not have the same rate of gamma increase during buy climaxes as during sell climaxes because of the nature of what's going on. And the result is that buy climaxes tend to be less severe as sell climaxes. The firms that sell the calls are not incurring the losses that they do during sell-offs from selling puts. And therefore, if the market has a series of buy climaxes, the firms that sell calls are under less pressure to hedge by buying stocks and futures. And the result is they don't add to the climactic buying as much as they add to climactic selling during a sell climax. This means that, in general, buy climaxes are not as extreme as sell climaxes because they do not have the contribution from the option selling firms, or as much of a contribution. I want to talk a little bit about consecutive climaxes that fail. We have a series of sell climaxes in a bear channel, and you assume 75% chance you'll get a bull breakout, bear channel, bull flag, but sometimes instead you get a bear breakout. In general, if you have a bear breakout below anything where there's a logical stop below, there's a 50-50 chance you'll get a swing down, 50-50 chance the bear breakout will fail and you'll get a reversal up. Bear channel, 75% chance bull breakout, or at least sideways and then up. 25% chance you'll get a strong breakout and a swing down. Here we have a strong breakout and decent follow through below a wedge bottom. We have consecutive bear bars closing on or near their lows, and we have that one big bear bar and then a pair of additional bear bars. There's adequate follow through. We're probably going to get at least a small second leg down, maybe leg 1, pullback leg 2, or leg 1, pullback, and then leg 2, the tail on the bottom of that bull bar. Bear breakout below the wedge bottom, decent follow through. The odds are we're going at least a little bit lower. Very tight channel. We have a breakout, so the market cycle starts over again. You have to assume breakout will be followed by a channel and then by a trading range. Here we got a very big trading range. Consecutive sell climaxes, you should always think of them as a type of wedge bottom because once you have 3 or more climaxes, it is a wedge. We have a sell-off, a rally, and then we're starting to sell off again. This is a double top bear flag. This is the neckline. So the first target the bears will look for, if the breakout is successful, is a measured move down based upon this double top bear flag. Whenever there's a breakout, you always have to be thinking about a possible measured move down. It might be from this high and that low, but if it falls below that, then you got to be thinking about from this high and that low. And traders will look to take profits on their shorts. Bull scalpers will look to start buying around that measured move target. A strong breakout below a wedge bottom is a low probability event, and that means bulls are trapped in. They've been buying lows for scalps all the way down, and here they're buying lows and they're not able to get a profit. They have to sell. And you have bears trapped out. They were not selling at lows. Now they think the market's going lower. They have to sell as well. The likelihood is that you'll get at least a small second leg down. The first reversal up, the trapped bulls will sell out of their longs, and the bears who did not short will sell. They'll sell the high of this bar or below the low of that bar. Here we got 2 legs down, but they're very small. That is the minimum though. The minimum is 2 legs down. Breakout, pull back, second leg down. Every trend bar or series of trend bars is a climax. We have a series of sell climaxes here. The bulls are trying to reverse up. They're breaking above a very tight channel. And then we get a very big final sell climax, bigger than all of the others. Whenever you have the biggest sell climax in a bear trend occurring after the bear trend has gone on 20 or more bars, it's more likely an exhaustive end of the trend rather than a measuring gap leading to a second leg down, a measured move down. And that's what we have here. We have a gap, we have a breakout here, a breakout point. The rally did not go above that breakout point. You have to be thinking the market will fall for a measured move down, maybe from this high to the breakout point, maybe from this high to the midpoint of the gap, and we fell to about that level. This breakout probably was simply a sell vacuum test of the measured move target. There probably is other support here as well. The weak bulls finally gave up. The strong bears look at this and say, wow, I didn't expect that. What a gift. I better buy back my shorts. And the strong bulls look at that and say, wow, that's way overdone. And they know the strong bears will buy back their shorts. The strong bulls start to buy. And the result is you can get a bull channel that can last a long, long time. No one left to sell at this price. 75% chance you'll get 10 bars, 2 legs sideways to up, 1 leg pull back, second leg, maybe, but a very tight channel, probably going higher. So maybe this is 1 leg, pull back, second leg. Here we have a bear channel lasting a lot of bars, maybe 40 or 50 bars. If you look at a higher time frame chart, maybe it's only 20 bars. But in any case, it's a bear channel that's lasting a long time. In general, I'm looking for a 10-bar two-legged correction on the highest time frame chart that has the same pattern. Let's say this is a 5-minute chart. You could look at a 10 or 15-minute chart and the pattern might be the same. I'm going to then look for 10 bars, 2 legs on that 10 or 15-minute chart. In general, the minimum goal is 10 bars, 2 legs, and a rally that lasts about half as many bars that there were in the bear trend. So for example, if you have a bear trend lasting 50 bars, you'd expect a rally that would have 2 legs and last about 20 or 30 bars. It might last a lot longer here, but that would be the minimum guideline before the bears will start selling again and where the bulls will stop buying. Consecutive sell climaxes, maybe the market will bottom. Sometimes when you have consecutive sell climaxes, you get one final very big sell climax. And traders look at that and they think, oh wow, it's accelerating downward and we're probably going down for another measured move. Maybe this will be a measuring gap. Usually not. If the trend has gone on for 20 or more bars and you've had a series of sell climaxes and now you have the biggest sell climax occurring late in the trend, more likely it's going to be an exhaustion gap. A gap between this close and that low. Once you get the reversal up, then the gap is this high to that low. We're probably going to go back above that low. We'll probably reach the top of the final sell climax and then decide whether to go sideways and resume down or break to the upside and go up for a measured move based upon the height of that sell climax. Sometimes it happens that when you get a series of sell climaxes, you need an even stronger sell climax before the market is exhausted and you get a reversal. Experienced traders will often buy that close, betting that the market's probably not going to fall much further. Higher probability to buy above this bull bar or above that bull bar. We have a breakout. A breakout of what? Well, of this low. We tried to bottom here. You got to be thinking about a possible measured move down based upon the top to the bottom of that leg, this bottom attempt, and we fell for a measured move down. We also have a very tight channel, small wedge bottom, 3 pushes down, 1, 2, and 3, and we have a bear breakout below it. So there is some support there. We have a reversal up, a biclimax, and then another biclimax. This is the biggest bull trend bar in the bull trend that started over here. This is still part of the bull trend. Whenever you get the biggest bull bar late in a bull trend, 20 or more bars into the bull trend, you have to be thinking that it could be a climactic end of the trend. It could be a measuring gap, this low and that high. Might get a measured move up from here to here, or from here to here. But we're about a 50% pullback of the bear trend, and we're testing prior lower highs. We're testing the top of this sell climax. Therefore, you got to be thinking that it could be a buy vacuum test of resistance and the end of the first leg up. Big bear trend usually evolves into a trading range, and therefore this could be a second leg trap, leg 1 pullback, leg 2 in a trading range. Eight-bar bull microchannel, actually more than 8 bars, but maybe 10-bar bull microchannel. Chances are the first reversal down, traders will buy it. Chances are the bears will need at least a micro double top before they can get any kind of a correction. We have a biclimax, we have a biclimax. Sometimes you have to get an even stronger biclimax before there's exhaustion and any kind of a reversal or a pullback. Rather than the bull rally ending here, it had to break above the top of the entire bear trend. The biggest bull trend bar, late in a bull trend, probably an exhaustive end of the trend. You can also call it a parabolic wedge. First leg, pause, second leg, pause, third leg, or first leg, second leg, third leg. Different computers see it differently. In any case, we have a bear channel, probably will evolve into a trading range, and therefore traders will look for a top of the range. The bears thought they might have had it here for a possible double top. Instead, we broke strongly above it, and we broke above the top of the entire bear trend. However, the biggest bull trend bar late in a bull trend, especially at the top of what could be a trading range, it's probably an exhaustive end of the trend. We broke above that high, but closed below that high. The bulls are taking profits. They saw this bar as a gift. At this point, we have a 13-bar bull microchannel, 13 bars without a pullback. And it's followed by a bear bar and then a second bear bar, a bear II pattern. Bulls will sell below here if they didn't already sell out, and bears will sell as well, looking for at least a scalp down. This is unsustainable behavior. The biggest bull bar late in a bull trend, testing the top of what could be a trading range, testing the prior high, probably a buy vacuum test of resistance, and probably an exhaustive end of this rally. Anything that is unsustainable is usually climactic and usually results in an end of the trend, 10 bars, 2 legs, sideways to down at a minimum. Again, different ways to look at this as a parabolic wedge, using these highs or this high and then that high. Consecutive biclimaxes, a severe biclimax, minimum goal, 10 bars, 2 legs, sideways to down before the bulls will buy again. Here we're sideways for about 30 bars, then the probability of trend resumption up falls to the same as the probability for trend reversal down. Biclimax ended with a tight trading range. The market's in breakout mode. Here we have a double top within the tight trading range. That is a double top lower high. Here's the high, double top lower high in a tight trending range. It's a double top lower high major trend reversal. 40% chance if we fall below that bar, we'll get 2 legs down, 1 pullback 2. Bulls and bears will sell this close. They see consecutive biclimaxes. They see the biggest bull bar. They see this close below that high. Some bears and bulls will sell here. The bulls sell out of their longs to take profits. The bears sell looking for 10 bars, 2 legs sideways to down. And those who do not sell here will sell here. We have a bear II pattern, 2 bear bars, this one closing on its low. At a minimum, we'll probably get 10 bars, 2 legs sideways, maybe down. If you want, you can also call this a triangle. We have 3 reversals up, 1, 2, 3. Double top lower high here, double top lower high here, 50% chance we'll get a bear breakout, 40% chance we'll get 2 legs down for a swing down, which we did. Traders who do not want to take the early short below this bar or below that bar have a higher probability of selling after they see 2 or 3 decent bear bars. They can either sell the close, sell the low of this pullback bar, or sell below the low of this pullback bar, a double top, this high and that high, low 1, low 2. I talked about climaxes are due to extreme behavior, extreme selling for a sell climax, extreme buying for a buy climax. However, a big component of the climax can be due to option selling firms losing money and having to offset their losses by taking positions in the underlying. So if the market is rallying strongly, their calls that they sold are losing money. They have to buy the underlying. If the market's selling off in a series of sell climaxes, the puts that they sold are losing money and they have to sell the underlying stocks or ETFs. And then finally, I talked about consecutive climaxes that fail. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on climaxes.